The market snapped its 5-day losing streak with the Nasdaq closing above the key 3,000 level. Economic data on tap includes jobless claims, U.S. trade balance, and PPI, as well as Federal Reserve presidents making rounds on the speaking circuit. I'm Taylor Schronce, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Jill Malandrino with theStreet, and together we bring you the morning call. We came off of 5 losing days. We were up yesterday, the Nas closing over that 3,000 level. So Scott, what we need to take a look at when we review this week's action was yesterday what's called an inside day to you old school technicians here. Are we just trading the previous day's range, or are we going back to that grind up?
Well, yesterday was that oversold bounce day that everyone expected, the easy part of the bounce that, relieves some of that pressure. And if you talk about pressure, you talk about oversold readings. And the McClellan oscillator, which I talked about on Tuesday, was screaming at a negative 95. That means you cover your shorts, and you could probably test some longs, but small, because again, we've been in the midst of a correction. So yesterday we finally had the bounce day. Today we're into day 2. So the question is, how far can we go, and what broken trend lines do we retest, and does the market reclaim them or reject them? And that's the only way we're going to know whether or not Tuesday's low is the low of the year, or we have further downside action in front of us.
So when going to take a look at the SPX, what's the new resistance level that we're looking at? Are we coming back to what was support a few weeks ago, and is that the new resistance?
Well, that's what usually happens. The old support turns into resistance. So if you look here at the chart of the SPX, you will see that first things first is the 50-day moving average. A lot of people thought it would hold on the way down, including me. But we broke through that like 1372. Then yesterday you had a small inside day and we couldn't reclaim it. So the question is, can we reclaim it today? So if you look closely at it, if you look at yesterday's high, first resistance is around 1374. I think that we probably get above this high over the next few trading sessions, and I think the real line in the sand where if you want to try and reshort this market, you could reshort this market around 1384 to 1386. If the bears have any controls, and if they want this market to take out this area to test 1340 or below, they don't let the bulls reclaim about 1384 to 1386.
Moving along to the sector spotlight, we're going to take a look at the travel names. You guys were very active in it's not only trading them, but on the Twitter feeds yesterday. The key with this group has been being within the hotel space, because the margins tend to be a bit higher there than the airlines or the car rental space. So let's look at Priceline, Scott. Benchmark took up their target yesterday, but it was one of the only ones that was red on the tape.
That's because the technicals controlled the action. And the day before, when we sliced through the 50-day moving average, the leaders started to sell off. They've been untarnished. The first part of the correction, people were like, oh, the leaders are acting great, and they did. Then finally, when they change, that's why you have to have high-level stops. So if you look at Priceline, you'll see 2 days ago, you had an outside day. That's when it opened above the previous high and closed on the lows. So yesterday was a gift for active traders. We opened up a little bit, so did Apple, and once it traded below yesterday's low of, what is this, about 739, you had a 20-point down move for cash flow right into important support. So now the question is, will it stay below this broken trend line right here and go sideways, and then perhaps take out yesterday's low for what could be a bigger correction? So I think that's very important for that group, as well as some of high beta tech names.
Moving along to Travelzoo, this is a name that has not been able to get out of its own way since it's disappointed with earnings back in July of 2011. It caught a bid yesterday. It's reportedly putting itself up for sale.
Well, rightly so. If they can't get it right and the stock can't go up on its own merits, they have to put them up for sale.
Equity.
Exactly.
Look
at RIM, look at Yahoo. Anyway, if you look at the chart here, it gapped up yesterday, and there really wasn't much follow-through. If you want to take a close look how it's just underperformed, during the course of the past 10 months, almost even at the lows as a broken business model. So who knows if this is real? Who knows if people want to get out of stock? But here's your inside day or yesterday's action. So you have the high, you have the low. If it goes sideways and stays in this area, perhaps you get another trade above yesterday's high. Yesterday's high is 27.94. Never buy a stock just on the basis of being taken out. But if it could technically go sideways, there's a lot of shorts trapped. I think above this area, maybe you get another trade. But for me, I'm going to avoid this one.
Moving along to Expedia, this is another one where it's hasn't been like that fantastic. It has a lot of exposure to the airlines and to the car rental where you're not getting those healthy margins there. PacCrest initiated with the neutral. Credit Suisse took up their target a bit, but still maintaining neutral on this name.
Well, this one I actually haven't even really heard in the last few months, where usually if there's action, I hear the name, and every now and then I guess you could hear of Expedia. Everyone's been talking, obviously, Priceline. You look at the chart here, I guess it tells me why. You know, for those of you that like to buy a dip, here you go. Stock is right on important support. Okay, I don't know exactly, you know, how they're being looked at for the quarter, but at this point, all I know is you have a low here of around 31.50. If it were to break this area, you know, this will be one of the first few to get down to the 200-day. I don't like the fact that it's below all three moving averages, so that shows you resistance right there. If it's going to start getting up on its horse again to go, it's really going to have to start breaking above this 33 with some volume. So at this particular point, you know, here's your support, here's your little trend line. You have to be a real Expedia believer if you want to stay with this. I don't think there's a real trade there.
Moving along to Starwood, ticker HOT. We saw some interesting options activity in this name last week where they're levering this up to $60.
Well, this one actually is acting well. I think this is more investor quality because, like you said, hotel margins are a bit different. You know, not really as, I guess, worrisome of oil prices and whatnot. So if you look here, this looks pretty good. Look at the chart. It too, you know, came into some important support. It corrected like the rest of the market. It was in the game near the highs. Came into this 52.98 area. It actually reacted well with the market. You saw a nice day, so that means when the market bounces, perhaps they go with this one too. I think if you want to be long on a macro level, be long versus this 53, you know, and then with time, it looks as if it can go higher. I do think your next pick is a better looking situation.
Moving along to Marriott, analysts are starting to warm up to this name because the timeshare space, which is something that we very rarely talk about, it's starting to improve. Nothing incredibly sexy, but they're seeing slower, profitable growth.
And I think if you have to go with one of them, this is the one to go with. So if you look here at Marriott, just according to the chart, it looks technically better. Okay, it didn't come in as much. It did hold support as well. It engulfed the previous day. I think Marriott, if the market continues to go, if it starts getting above this 37.50, it could be back in motion for new highs. I do like the fact that it actually held the 50, where a lot of other scenarios broke the 50. So that's showing me some institutional support. So I think out of, you know, Starwood or Marriott, Marriott's probably the one to go with.
All right, we'll have to keep an aim on those. On the travel space, it looks like it could be really interesting for you momentum guys out there. We're going to go to a quick commercial. When we come back, we jump into the trenches.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Welcome back to the morning call. We're going to jump into the trenches with the Dow 30 overbought, oversold names. Two are barely in the overbought territory. What's interesting in this group always moves with the market, hence Dow 30. We're going to look at our first barely overbought name with Boeing.
Okay, Boeing was a name that I tried to, as a momentum trader, get involved in, and there was just no momentum. Stock's been choppy, stock's been consolidating, but what do you expect? It's part of the Dow 30. If you look here at the chart, you'll see that it rolled over a bit. You know, we were all trying to play it right around here, me included. I remember buying it on this day, it didn't break out, buying it on this day, it didn't break out, and then now it's been just dripping lower. So if you can't buy a breakout, maybe you could buy a pull-in. So if you like the fundamentals of Boeing, you know, it just pulled into 70-ish, it held, maybe you get in a tier 1, but you know, for any traders to really get involved or want to be involved, I think it's going to have to start getting above this level, have some big wide range bars, almost like you saw here or like you saw it here. So I guess it can happen. You saw it back there, or you actually even saw it over here. So at this point, be in tier 1. I don't think you need to be in anything more than that unless it dips all the way down with the market correction there, and then you'll have to talk about whether you want to average down or just stay the course.
Moving along to CAT. The ag space is clearly my favorite for 2012. We all know that, unless we've been under a rock. CAT clearly has exposure to the ag business.
Yes, and this one, everyone loves to love it, and they probably don't like it as much as they did, you know, a month or so ago. But if you didn't like it then, or if you didn't get involved then because the technicals were showing you of the potential pull-in, it's coming into an important area right now. So if you're not in CAT, if you take a look, okay, and you got out, you know, when you saw it get resistance at the highs, or you saw it break below the moving averages, well, this is the prior breakout. If you remember when we were getting involved, you had this nice little channel here, and it broke above this 97. You had a big move to 115. So now coming back into the 100 level, if you're not involved, I think this is your spot for a tier 1. But remember, you're buying a dip. You're not playing momentum, so if you buy here, I don't think you're going to get any momentum until we're out of corrective mode, and then once you see this somewhat of a downtrend change, maybe it gets in motion. But for right now, the trend is still to the downside. But this, 97, 96 area probably makes sense to nibble if you sold some strength.
Moving along to Chevron, the refiners have had a hell of a time for 2012. We saw Conoco last year making the announcement they're spinning off their refining business because the margins just aren't there. Let's take a look at Chevron.
Chevron, just like the rest of them, have been underperforming. So when they're underperform, you don't need to be there. And if you look here, there was a technical day that I remember pointing out right here. If you guys know me, I love the red dog reversal, and there it is, rightly so. Stock tried to break out and close there. That meant that this uptrend was over. That means you get out of it if you're in tier 2, tier 3, you get to tier 1 only if you're a macro investor, and if you're a momentum trader, you could have got short right there because it never violated it. So anyway, fast forward, look where we're at. We're below all of these moving averages. So to me, I don't touch it. But if you're a fundamental type of situation where you invest that way, I guess you look for a dip to buy. And if you look at support areas right here, you have this 100 area. So again, if you sold that day, maybe you look a little forward and you buy some into 100, but this stock's gonna have a lot to prove, and so does this sector.
Moving along to the consumer staples space, Stephanie and Kramer, they've been slowly accumulating in craft. Typically when the market is a little bit shaky or unclear of direction, you can look for a little bit of consistency in staple names.
Okay, and sometimes you need time to accumulate. It all depends. If you're like a fund and you need to accumulate, you accumulate something slow, and that's why sometimes when they don't technically look good, you use your fundamental accumulation and use your thesis, and every now and then everyone has their own thesis. So go to craft, see it King on KFT. At this particular point, this would have been your way out when it broke support. Okay, and if you did sell it here, why not try and buy where it broke out from? But at this point, it's really not showing you any signs of life. Like yesterday, the market rallied, and this one closed in the lows. So to me, still don't love it. But I guess if it comes back to test this gap, comes into the 36 area, this would probably be an area that should hold. So if you're playing the accumulation game, just know not to get too much too early and keep looking at the price points. For now, as a technical trade, I don't see any type of reversal yet.
Let's round it out with one of the big conglomerates, Triple M. We're also going to talk about GE for our options profits play. These names are all going to start reporting next week and the week after, and that's where we're going to get some sort of read on the economy, not just domestically, but also looking global.
Yeah, and once again, if you can't get breakouts in these, you have to, I guess, accumulate it on the dip. And if you're accumulating a position, why not do it with a good average cost, but don't do too much until you finally see it turn. So if you look here at Triple M, this also, I know I tried to get involved in this tight base because we know I like tight bases because typically what happens, they expand, when they go. And this one was just kind of in its own little world here. And then it looked as if it was tightening up again. Right here, you had a nice little wedge type pattern, and then it broke to the downside. And now you have all these moving averages on top of it. That's going to be resistance. It is in decent support land, right? This was your wide range bar on that Tuesday inside day. So if you're not involved and you want some exposure, be in a tier 1. But at this particular point, again, this isn't showing me any signs you have to rush in. You still have some lower level areas. It's below all the moving averages. So to me, I would still be light. I'd be light in all of these things because none of them are really showing me that they're blaring buys.
Right. Well, I guess until we get some confirmation in the market and its direction, especially with these Dow 30 names, I think that thesis is 100% correct. Let's move along to quick hits for quick cash. We're going to take a look at Apple. We have a couple thousand plus targets out there. I read something really interesting on the Twitter feed last week, and I wish I could remember the author's name because this was fantastic. He's taking his target to 2275, which is AAPL on the keypad, because anyone's throwing out numbers at this point. I thought that was funny.
Yeah, that's funny. A lot of people are trying to make names for themselves with this. I typically love to be an Apple bull, because that's the way it's been for the past few years. But every now and then it gets a little choppy, and right now it's a little bit choppy. So if you look here at the chart, let me show you what I was seeing the last few days, okay? I actually made my money yesterday shorted because look at this outside day. This is when it opened up above the previous high and closed on the lows. So I really need to show you the 13-minute chart of why I actually shorted it yesterday because here was that breakdown. This was that little flag pattern that wound up giving away, and that's when the market accelerated. So on this gap up into the prior resistance, that's when I got short. And then it actually showed relative weakness yesterday when it flagged again. So a lot of people are like, why are you tweeting short? All the Apple lovers. I'm like, you know what? It's a good trade. So PS, below 632, wound up going down to 625, which was a nice trade. So now the question is, does it hold this upper level? If you look here, I'll give you, I'm sorry this is turning into a long hit, but I'm always long with Apple. It's right on the 10-day moving average, and I just want you to be a little bit careful. If it does break yesterday's low, the next area that could easily be tested will be this 20-day moving average, and then you have much bigger support down here. This trend has been fast, furious, and they always stay intact till they break, so just be a little bit prudent coming in here.
Scott, I think you made an excellent point in terms of trading Apple, because people get so married to the company or married to the product that they forget what it's like to actually trade. And we're here to trade, not necessarily fall in love with the product. So separating your psychology from the trade is a really key point here. We're going to move along to Dunkin' Donuts. Scott, you've done a fantastic job teaching us how to trade these IPOs with Caesars, with Coors. Let's take a look at what Dunkin's been doing.
Well, Dunkin', I'm being a visionary, and the technicals are starting to line up. Obviously, you brought out Starbucks at 50. It's been on a blockbuster run recently, and if you've been an investor in Starbucks since the get-go, you're probably rich, or you're doing very well for yourself. So Dunkin', I like the story. I like the Starbucks side of it, the McDonald's side of it. So as an IPO, it now has over 10 months underneath its belt. It's been accumulated. It just had a secondary that I think is behind us, so that's been absorbed, that resistance. So if you look here at the chart, to me it looks good. I see technical points here. This was the last time we spoke about it. You had a nice little cup handle, broke out, couldn't get through those old highs because I think people knew a secondary was coming, and then you had a pullback, into the price. It held 29.50. Now, if you look real close here, at this level, there's some nice resistance. It's still holding up well. This is above the moving averages, which I like, trying to take out even the 10-day. So I'm long Dunkin'. If it can get above 31, I think it puts it back in motion for a move to the highs. And at some point this year, I think you could see 36 to 40.
Moving along to JP Morgan, the banks are going to come out fast and furious with earnings, kicking off with this big name. Yesterday, we heard in the news that they're starting to subprime lend again. So I'm going to be curious to see what they're saying in the conference call regarding loan quality. I think that's going to be a real key metric for the banks this quarter.
I agree. And I don't think you need to chase them right now. They had big moves. They're in consolidation mode. I know on Tuesday, that was one of the stocks I went with to play for a bounce, and I'm still long JP Morgan, but I'm probably not going to be long it into the earnings because I'm risk averse. So if you look here at the chart, you will see that it's acting well. It's still above the 50-day. Most indices all pulled back to the 50-day, and JP Morgan's holding higher. So it's showing you that there is demand there. This is why I wanted to buy it, because it came into the support, closed well yesterday. I would say above yesterday's high, which is about 44.21. I think you could see 44.70, and that's hopefully where I exit my position today, and then I get to look at the report tomorrow.
Moving along to my 2012 pick, Mosaic. Yes, I know it's been beaten up, but yes, we've said this is a long-term trade, but we're traders by design, so we can also play it in the short term as well. This is why I really love it. We expected choppiness in Q1. We're going to see it in Q2. This is a back half story. What's important to note here is nat gas closed below $2 yesterday. That's the first time it's done that in 10 years. You know what? That makes input costs cheaper for the fertilizer names.
Okay, and like you said, two different time frames. If you're a momentum trader, no need to be in many of these ags, because every time you try and trade it for momentum, they fail. If you're an investor, just be in small until you see some type of turn. And we haven't seen that yet, but I'm sure when the thesis kicks in, that's when you can get a little bit more aggressive. And if you look here at Mosaic, you will see that, with the rally or with the decline in the market, that's what I want to show you. Like, here's your little topping tail. That was your signal that it might be a little bit overdone. You talked about buying it down here. So from 46 to 59, great call there, Jill. But right here was your little, sell signal. And since then, it came back down, didn't hold support. So I would say if you're not involved in this and you want to try it verse 49.51. But if it breaks this level here, 49.51, I think you still could see, weaker market, down to this 46 area, and that's the risk there.
Moving along to Wynn, we're going to wrap it off with Scott's. I think you just trade these casino names fabulously. So I'm excited to wrap it up with Wynn. Moody's is predicting that Vegas is going to draw in its record revenue for 2012. So these casino names really have some solid momentum, not only on the charts, but fundamentally behind them.
Yes, and I think what's holding this back is that shareholder lawsuit. That's the overhead resistance, because we all know Wynn used to be, the alpha leader until my boy LVS took it over. Sheldon, great job. He opened Couture yesterday. What is it? How do you say it?
They're opening up a $35 billion complex, and they're going to commit $35 billion to Spain.
Yes,
for the new Vegas.
And that's an additional one besides what they just opened up yesterday.
I say we go for channel checks.
So that's going on all cylinders. So Wynn, I think there's an opportunity for when it ignites. So if you look here at the chart, it's a little bit of a laggard, but we talked about buying it here around 116, had a nice move into the resistance area. Ever since then, it's been somewhat consolidating. It held the 50-day. I think if it could finally get above 130, 131, that will be some time momentum comes into it, and then the next level of resistance will be 140, and then you have those highs. Right now, I'd say it's a tier 1 Guys trying to trade it are getting chopped up. The momentum hasn't been there and win. But once momentum comes back, that's when you have to have it on your trading plan every single day.
All right, guys, we got jobless claims, PPI today, and tomorrow's the CPI, and we're also looking to see if this is a trend back to that upward grind or just a bounce. Catch Scott at the end of the day, every day, T3 Live, OP, and Real Money as he wraps up the charts.
Have a nice trading day.